Hi, everyone, and welcome to the fourth episode of Hub Talks, a space for us to discuss topics emerging from the local and global scene in the FinTech community. My name is Arif Ismail, and I'm the chairperson of the IFWG, as well as the head of FinTech at the South African Reserve Bank, and of course, the host of Hub Talks. The South African Financial Services Regulators established the IFWG already in 2016 to understand the growing role of FinTechs and innovation in the South African financial sector. And of course, to explore how regulators can more proactively assess emerging risks and opportunities in the market. Recently, as you'll recall, the IFWG launched the Innovation Hub, albeit digitally, at the end of April, and of course, with the aim of demystifying the regulatory landscape, providing a safe space for experimentation, and of course, actively advancing innovation. In today's session, I will be chatting to Joseph Noss, member of the FSB Secretariat, and Jon Frost, senior economist at the BIS, regarding Bigtech and FinTech. Hi, Jon and Joseph. How are you today?
Hi, Arif. Doing very well.
Hi, Arif. Fine.
Excellent. Lovely to be in touch, gents. I can't wait to dig into this conversation with you. In fact, we've been on this journey on FinTech and so on for a long time. So great to get your insights. Jon, if I could trigger off with you, always great to be in touch. We've been on this journey of exploring and unpacking FinTech from the very early days of the Fin, as well as the FinTech Issues Group, the FIG. In your view, Jon, how important is FinTech to reshaping the financial services landscape? And what areas of FinTech innovation, in your view, has the most potential?
Thanks a lot, Arif. So FinTech, I think, is very important and does have a lot of potential. Indeed, FinTech innovations have emerged in countries around the world, in Africa, but also in South Asia and East Asia. There have been large strides in financial inclusion, thanks to FinTech innovations like mobile money. And in Europe, North America, and the advanced economies of Asia Pacific, FinTech has helped to make financial services more accessible and more convenient. So FinTech innovations very often start in payments, but they afterward diffuse into areas like credit, insurance, and wealth management. And FinTech innovations often come specific market failures, for instance, by reducing information asymmetries or transaction costs. But at the same time, FinTech activities remain subject to the risks traditionally present in finance. So this includes things like liquidity mismatches, speculative bubbles, interconnectedness, and potentially systemic importance. So as such, there's still a very important role for policy, and in particular for financial regulation, to help harness the opportunities, but also to mitigate the risks.
100%. So what Jon's capturing for us is that the first avenue for FinTech is usually payments, but very quickly we can see that the kind of activities that FinTech firms get into, as has been mentioned, spans investments, insurance, and so on. So fantastic. Jon, if I could stick with you, what were the main findings of this infamous FinTech Issues Group report? And do you think they are still applicable, or has the domain shifted?
Yeah, so the FinTech Issues Group put out its report in June 2017, so almost exactly 3 years ago now, under the German G20 presidency. So Arif and I had the pleasure of working at the time with the chair, Carolyn Wilkins, and with members of that group. And the report noted that the emergence of FinTech brings both opportunities and risks to financial stability that policymakers, regulators, supervisors, and overseers should consider. And it laid out a framework for assessing those risks and benefits. So the report noted that FinTech activities are still small and that the data are often lacking. Still, it identified 10 issues that merit authorities' attention. And these issues have turned out to be quite prescient. So they include things like managing operational risks from third-party service providers, for instance, in cloud computing, mitigating cyber risks, which I think we all know have continued to be very important, and also monitoring macro-financial risks like systemic importance and procyclicality. 3 years on, it's clear that FinTech activities are still fairly small on aggregate. So the global financial system had about $300 trillion of assets in 2018, according to the FSB's non-bank financial intermediation monitoring report. So compared to that 380 trillion, fintech activities, including in areas like fintech credit and crypto assets, are still pretty small. But they are becoming economically relevant in some countries and in some market segments. So particularly big tech players are becoming economically important with a large footprint in payment markets, and in some cases, for instance, in China and some other countries, also in credit, insurance, and wealth management.
Fabulous. So that's a great way to kind of segue into introducing Joe and getting your thoughts, Joe, on big tech. John's mentioned big tech. Often when people hear these terms, fintech and big tech and so on, it tends to cause some confusion and some misnomers. What, in your view, Joe, is big tech, and why is this phenomenon so important, and why does it matter?
Sure. Well, big tech firms are large companies that already have established technology platforms as part of their core business. They've grown rapidly, or many of them have grown rapidly over the past couple of decades, and some are now comparable in size to the world's largest financial groups. Some are also now household names that we use daily for internet search, that provide us with our mobile smartphones, that provide us with our social media and online retail platforms. And some of these big tech firms are starting to play quite a prominent role in providing financial services. They typically benefit from quite substantial existing customer bases from their core technology platforms. And from those customers, they can collect data, which they can then use to target their sales of financial services. This is just a form of cross-selling, and cross-selling is not a new concept in financial services, of course. Many of you might have had the experience of going into a bank branch to pay a check back in the days when we used checks, at least in the jurisdiction I'm from. And while you were paying in that check, the cashier might have offered you a savings product or a credit card on the side. And all the bank's done there has been to look at your current account activity and your current account data, and it's identified that you might be interested in and eligible for another financial product that they can offer you. Big tech firms do the same, but on a much larger scale. Cross-selling is their lifeblood, if you like. Every time we search online, every time we chat to our friends on a social network or make an order on an online retail platform, we're giving away for free almost data about ourselves, our preferences, our pay, etc. And that data can be used by those big technology firms to pitch financial services in a way and at a price that more precisely affects our circumstances and, of course, our risk profiles financially to those firms. Now, you ask why this matters. I think it matters because big tech firms can become significant players in financial services quite rapidly. We've seen a bit of that already in some jurisdictions, particularly in some emerging markets such as China, where some big technology firms now offer a whole suite of financial services, lending, insurance, asset management, different types of online banking, some of them through a single app or collection of online apps on a smartphone. And we're starting to see it too in advanced economies, where some firms have started to make inroads, at least on the payment side of things. And there could be some further developments quite shortly on the way there too in some of those countries.
Fantastic. So, not just cross-selling, but leveraging the data that's available, and they could become quite large and impactful in the financial services landscape. Let me turn attention, John. Modestly, I've been following some of your work with great interest, especially the research on big tech, especially within the credit intermediation space. What are your main observations and findings, John?
Yeah, so we put out a paper on big tech and the changing structure of financial intermediation last year. It's a BIS working paper, and then there was also a special chapter in the BIS annual economic report last year on big tech and finance opportunities and risks. So in our research, we looked at the drivers and the implications of big tech and finance, in particular on credit intermediation, as you said. And we found that overall, big tech firms lend more in countries with less competitive banking sectors, so higher markups, and also with less stringent banking regulation. And we found with data from Argentina, from one big tech lender, that big tech companies, can use alternative data for credit scoring. So what Joe was just discussing, the alternative data that big tech companies can collect from their platforms can be of use in predicting default and in pricing credit. We found that big tech lenders have an information advantage relative to a traditional credit bureau. So for borrowers in Argentina, but also for borrowers in China, based on data from another FinTech, big tech firm, we found that the companies, the small businesses that actually accessed big tech credit, expanded their product offerings. So this is a key advantage of using big tech credit. They were able to grow their businesses more than similar companies who didn't have that access. At the same time, we noted there can be risks because these models have not yet been tested through a full economic and financial cycle. So we don't yet know how they'll perform during a downturn.
Excellent. That's deeply, deeply insightful, John. Thank you for that. As you've noted, some of that work is even available on the BIS website. Joe, if I turn to you, I want to split it into two questions. The first one is, what excites you from some of the big tech findings in other jurisdictions?
Sure. Well, I think what excites me the most is how great a force big tech firms can be for financial inclusion. You see that in some emerging markets where substantial populations remain without access to financial services, with all the attendant implications that has on economic growth. In fact, last year, nearly 2 billion people worldwide, for example, didn't have access to a simple, basic bank account. Traditional financial services, a bank account, for example, tend to come with considerable upfront costs, particularly in developing economies. It's expensive to operate physical bank branches, particularly in remote areas. And accounts tend to come with high upfront fees and maintenance costs. That all acts as a quite substantial barrier to financial inclusion. Big tech firms, as we were saying a moment ago, can use technology to offer financial services more cheaply. Many customers have access to technology in the form of a mobile phone. In fact, around 2/3 of the world's population now owns some kind of mobile phone. And that technology can act as a fantastic gateway to a bank account, a digital wallet, a payment service provider, etc. There are also some interesting examples of how new technology can take advantage of the capabilities that smartphones now have. One example in fintech space, for example, is the widespread adoption of quick response QR codes in countries like China. Those QR codes allow customers to quickly make payments just from holding up their smartphone and scanning a QR code. And they remove the need for costly merchant payment terminals and phone lines, internet connections, etc. Another important factor driving these developments is how in many emerging markets, populations are relatively young and ready to embrace technology. We just did a survey of some of our members and found that in some emerging market and developing economies, over 90% of the population is under the age of 30. So these are people that have really grown up with the internet and have had smartphones for the vast majority of their lives. And they like the speed and convenience of digital financial services. And there's an enormous opportunity there for big tech firms. Big techs already have high levels of brand recognition. People are used to interacting with their social media platforms, their messaging apps, etc. And that gives rise to a certain level of trust. A personal anecdote, if I may, I remember explaining internet banking to my mother 20 years ago. And her response was, well, I'd never trust my money to one of those computers. I'm going to keep going to my regular bank branch and queuing up to pay in my checks and make account withdrawals, etc. I mean, what's interesting now is that we have a generation of young people in emerging markets. Many of them don't have bank accounts. Some of them never will have bank accounts in the traditional sense. But they do have mobile phones, and increasing numbers of them will continue to get mobile phones, and that they can use to access financial services. And to me, I think that's quite exciting.
Absolutely, fantastic. So the importance of mobile technology, etc., coming to the fore in Joe's explanation. Joe, I have to ask the question though. I mean, you've described really well what excites you. May I ask and put you on the spot and ask what concerns you?
Sure. So I mean, I guess every silver lining has its cloud. There's a reason economics is called the dismal science, and with those opportunities, of course, comes risks, including those that we're acutely aware of here at the Financial Stability Board. I mean, one thing I'd flag is that big tech firms all are already, as their name suggests, big or large by many measures. And as they take steps into financial services, they're able, and they have been able in some jurisdictions, to achieve scale very rapidly. And that, I guess, might mean that they come to dominate the market for certain financial services over those traditional financial institutions. Now, that's not necessarily a bad thing. Competition can be very healthy, particularly in the banking sector. It can drive broader innovation. But policymakers globally, I think, might need to think through a few things. For example, what does that competition mean for the resilience of traditional financial institutions? What should we expect, or expect regulators to expect, in terms of standards of firms' risk management? What onus does this place on the official sector to conduct appropriate monitoring, particularly where, you know, some of these big tech firms lie outside of the perimeter of traditional financial service providers with whom regulators are used to interacting? You know, do we have the necessary data to keep an eye on what these big tech firms are doing? Have we fully thought through the consequences if one of these firms were to run into trouble? And do regulators have in their toolkits the power to respond rapidly and do something about that?
Absolutely. I think I've anecdotally said before, big tech firms are too big to ignore as we go forward. Jon, can I ask, do you want to add stuff to what Joe has been saying in terms of excitements around big tech or concerns around big tech?
Absolutely, yeah. So just to complement what Joe was saying, so there are issues around competition, around financial stability, and around data privacy that big tech activities in finance raise. And the Bank for International Settlements has also analyzed these in depth, again, through the annual economic report that I mentioned that came out just of June of last year. And that report emphasized that there is this feedback loop, this data network activities feedback loop, or DNA. So big tech firms have access to a lot of alternative data, a very wide network, and a range of activities, and this can be self-reinforcing, and it allows them to, as you said, achieve a dominant position very quickly. So financial sector authorities, financial regulators, of course, have a mandate for preserving financial stability and for assuring consumer protection, but often also an interest in ensuring fair competition and ensuring data privacy. And to be able to do that effectively, they have to work together with other authorities. So that includes competition authorities, data protection authorities in many countries. And it's through international organizations and through national working groups like the IFWG that I think authorities can work together and assess those issues that are of mutual interest and ensure that the risks that big tech business models bring can be effectively mitigated to harness the benefits.
Fantastic. Thanks for sharing those insights, Jen. So, Jon, if I could turn to you again, and this is a naughty question, but I have to ask it. If there's one piece of advice you have for South Africa in terms of its approach to fintech, what would that advice be?
Sure. So I think the advice would be, first of all, learn from other countries and let them learn from you. And Arif, I know that you've lived this, so you've been in the international groups and shared the South African perspective, which has been very valuable. You've also hosted the Financial Innovation Network meeting in Cape Town in January, and allowed regulators, central bankers, ministries of finance from around the world come to South Africa and speak with local firms, academics, and other authorities about their experiences. I think this is an area where authorities often face similar issues, similar challenges, and where they can learn a lot from one another. And I think through international cooperation, it's possible to share experiences, learn from experiences, and ultimately better support policy goals in countries around the world. So the advice for South Africa would be very much see what's happening in other countries and let them see the important lessons that South Africa has for other countries as well.
That's fantastic. That's really fantastic. Joe, I can turn to you. What do you think will be the most impactful innovation emerging from FinTech and Bigtech?
It's a good question. The most impactful innovation. I'd be tempted to turn to some of the innovative use of data, drawing on that point about the DNA that John made earlier and that I know we discussed at length in Cape Town. The way I think that FinTech, including big tech firms, are able to use customer data and combine it with recent advances in not just computing power, but also machine learning techniques to offer services to consumers that those consumers wouldn't be able to access from traditional financial institutions. I think that's likely to be quite impactful over the next few years. I mean, let me give you a couple of examples. In China, for example, some big tech firms are using data from their smartphone messaging and social network apps to look at patterns around customers' contacts, who they're talking to, when they're talking to them, etc., and using that data to predict their future financial health and creditworthiness. And that lets them extend loans to customers with limited credit histories, limited collateral, who would be very unlikely to be able to borrow from traditional banks, at least at economic rates. In Kenya and in Tanzania, fewer people have smartphones, but many still have those basic pay-as-you-go mobile phones with a simple screen and SIM card. And one big tech firm that John and I spoke to uses data on the frequency with which customers top up their phone credit to assess their financial health. So, for example, a customer who tops up one large amount at the same time every month might have a salaried job. One that tops up small amounts on a more ad hoc basis, maybe in more informal employment. And that allows firms to make decisions about how much they'll lend and at what cost, and to open financial services to a much larger range of consumers. I think that use of data gleaned from technology, some of it new technology like smartphones, some of it what we might think of as relatively old technology, feels quite important and is going to be an important driver of things to come. It's reliant, of course, on a whole new of analytical techniques, what some people call artificial intelligence, machine learning, some of which take place and run in the background via new technological infrastructure, cloud computing, for example, that John mentioned earlier. And as I said, none of it comes without those clouds, without risks, but it certainly feels, to me at least, like something worth watching.
Excellent, absolutely excellent. Gents, it's been delightful, but I've got to conclude by asking you maybe a broad question. Is there anything additional that you would like to add before we bring this to a closure?
Sorry, go ahead.
Go for it.
I was going to finish with a third anecdote, if I may.
Oh, please, delightful, please.
We've probably all had the experience of going into a regular bank branch, taking a ticket and waiting for 10, 15 minutes and filling out a paying in slip to go and speak to a cashier to apply for a loan. We go home, it takes a month or whatever. Eventually we get a letter from the bank telling us our loan or our mortgage or whatever has been adjusted or approved. About 18 months ago, John and I went to visit a very large Chinese big tech firm. It was a fascinating day out, and I thoroughly recommend the experience to anyone who's watching, whoever gets the opportunity to do so. But one of the things this firm did was they showed us into the sort of nerve center of their operations, kind of what a bank would call a trading floor. but what this big tech firm called their sort of customer control center. And it was this big Star Trek-like environment. And we sat down in front of this bank of monitors. And one of these monitors was drawing a graph in real time of how long it was taking this big tech firm to approve its customers' loans via their smartphones. And the guy that we were chatting to explained that at the moment that graph was hovering round about the 40 millisecond mark. So it was taking roughly a 20th of a second for this big tech firm to approve customer loans. And the person we spoke to explained that if that number got above, I think it was 800 milliseconds, an alarm would ring. This was an emergency for their business. Wow. If it was taking up to a second to approve a loan. I just thought that was fascinating, and it gives you a sense of some of what might be likely to come as fintech advances and big tech firms take further steps into financial services.
Oh wow, that's a really powerful story, Joe. So it's not just about data, but it's the time to make decisions, the decision-making time that's so fundamental. Jon, if I could turn to you, what are your thoughts?
So just to add, I mean, this is a very fast-moving space. You know, developments in big tech and finance are happening all the time, not necessarily in milliseconds, but at the very least in weeks and months. So this is a great place to do research. I know that a lot of students, also some that we spoke with when we were there in January, are very interested in these topics, and I encourage people to look into this area and to do research. At the BIS, we also have some more research that will be coming out soon, looking at fintech and big tech credit markets around the world and providing data that other researchers can use to try to assess and analyze these developments. So we think that this is an area that has a lot of potential to look into further, and it could be very important for policymakers and for the good of society.
Absolutely. Jon, we look forward to reading those insights and as you say, learning from the research that's been done. Gentlemen, thanks so much for your time today, both Joe and Jon. I think this was a really interesting and insightful conversation. I'm sure our listeners are going to enjoy this tremendously. I just want to thank you for your time.
Thank you, Arif.
Thanks a lot, Arif.
Okay, guys, that's it for today's episode of Hub Talks. If you would like to find out more about the IFWG, please visit www.ifwg.co.za. Please stay tuned for more content from Hub Talks in the coming weeks. Stay safe, stay healthy. Cheers.